Yeah, hope you guys are doing very well. Let's swing over here real quick because today is going to be about one major thing. Government shutdown, right? Make sure it's typed in. Make sure it doesn't say AI. All right. So, digging up, that means we got to do it again. Doesn't know how to share the first time. It's like a kindergarten kid. It's going to freeze for a second. I don't know why Zoom has been doing this, but it's been doing it over and over again on every computer that I have, and I have stopped it twice, and now we are frozen. We are completely and totally frozen. Thanks, Zoom. The worst. Let's try again. Hey! Hey! This is going great. So I'm gonna have to reinstall this again later today. I can't wait for that. But before we get to that point, we can talk about what I look like and feel like without coffee. I'm gonna turn around and I'm going to grab that because I need it. All right. So let's dig into this. We're going to talk about momentum. You will get the runner at 9 o'clock. But first, we have to talk about the government shutdown because once again, as we dig into the current state of the market and we pull up futures and showcase this big red and green thing, 6708 does not feel like a negative momentum environment. It doesn't feel like a yellow momentum environment, but I assure you, we are getting there. The FNGD, which is what we usually watch, is starting to wake up again, volume picking up back above that 20-day moving average. So, yeah, I'm going to be on a little bit more high alert, which is why as this market opens at 9:30, it's more important than ever that you do chat with us, that you have a conversation with us, because the next couple of days will be very interesting and very unpredictable. Now, the chatter and the noise is going to be around the data sets. We'll talk about that in a moment. But really, what I want you to think about is in this environment, this is an environment where funds and algos and broker dealers, they can really, really, really take advantage of news outside of the trading hours. So there will be optimism building around a 5 o'clock meeting around Capitol Hill. You'll see that optimism. You'll see futures rise, and then the market goes open. And if you try to chase that, you may find yourself that you are just positioning yourself to become the exit liquidity in this environment. And it goes the other way as well, where something seems very negative overnight, sells off, start the morning, and then we turn right back around and rally, which is why we have to pay more attention than ever to momentum at this moment. We are currently in the intraday reading at a -2 number of stocks breaking out versus the number of stocks breaking down, giving us a good indicator of outflows and inflows in the markets. But I want to point something out. When it comes to sectors, what we have to start to really do is pay attention to which sectors are looking strong and which sectors are breaking down. Right now, we're seeing weakness in the consumer cyclical space. So that is, again, the WANT is what we pay very close attention to. Want. We're seeing some challenges when we look at the bottom end of the Russell 2000 at the moment. Real estate has seen some pressure. Financials continue to see some pressure. That's not changing yet. Again, you see the DPST. This is the regional banking space. This is where we shared those concerns last week about the state of reserves in the banking system. And if you watch the KRE now breaking under its 50-day moving average, this can be problematic. This can signal some sort of issue in the regional banking space that a lot of people are not picking up on. And I encourage you to watch the FAZ, which again, a bearish ETF around banks. If this starts to break out, there is a problem in the repo markets. There is a problem in overnight lending markets. Easiest way to put it. Again, we've seen big moves that have happened in the past around banking. These are all major liquidity events that have transpired, particularly these huge spikes in this bearish fund. Banks are negative right now. We'll see if they continue to break down, and it will take a lot of other things with it. So today, as we talk about momentum, which I anticipate will firmly shift to yellow, if not red, by the end of the day, simply because of the headline trading. I want you just to be aware that there are certain things that you will need to watch over the next couple of days to really have confidence that this market can continue to move higher, or if this is going to kind of be one of those panic events where people dump because we've just had a phenomenal rally going all the way back to April. We're heading toward the end of the year. Certainly, a lot of funds who might have missed rallies would love for something to move lower, and they're able to buy back in, particularly as liquidity remains strong in the third quarter, particularly as there is typically a 3 month lag in liquidity, which means not expecting the markets to really burn higher for the rest of the year, but expecting enough support through the end of the year. And I think that there's still a lot of people looking for justification in a bigger sell off. So, just to take a little bit of a step back, right? What is a government shutdown? And it sounds like we're just everybody goes home, right? But really, this is a funding issue. It's boring as can be. It's a policy matter. It's when Congress is unable to pass appropriations or a continuing resolution by their deadline. And their deadline was September 30th of this year in order to fund government operations. Now, obviously, we know that government operations are expensive. Agencies that lack legal authority to spend money have to furlough their non essential staff or suspend operations. And that's things that are not essential. Air traffic controllers are essential. National security is essential. And typically, most of these groups will continue without pay until funding is restored. Other government furloughed employees are actually going to get paid whenever this is resolved. So the immediate issue is with this is just general uncertainty. Things like the SEC and the FDA, they might be reduced at reduced capacity. You'll have delays in approvals. This can impact the IPO market. It can impact enforcement on SEC claims. And we also see that traditionally, when shutdowns occur, we have seen these metals do quite well. And we are at 3,900, a new all-time high for gold. Silver pushing toward that level that it hit back in 2011, right around, you guessed it, another shutdown. Equity markets may edge lower, and futures are already showing some weakness in response. Now, how does this relate to the economy? That's really the key thing at the end of the day. And it's the idea that government purchases, permitting, grants, regulatory authorizations, that huge swath of capital that is the government, especially after COVID, could slow down, and that can impact the private sector and it can impact investment. Sentiment can weaken if furloughed employees want to reduce their spending. We already see consumer sentiment at very weak levels. And if the shutdown does drag on, and this one does feel like it could drag on a little longer than usual, the cumulative impact could be more material. So a drag on economic growth, supply chain issues, and credit strains in very sensitive environments. So we know the 2013 one pretty well. There was a minor dip and a relatively sharp rebound. Duration is important because short shutdowns are barely felt. The prolonged ones are the ones that will bite the market. And what we're looking for is once the markets get some level of clarity on what's going on, the longer term trend will return and dominate. So we're looking for a reversion, and we're looking for government dependent sectors, particularly defense, infrastructure, and regulatory side, to face more stress in the short term, but then rebound over the long term. The key things that make this shutdown different are pretty critical. The first is valuations. So the market's hyper priced for growth. We're at levels we haven't seen since 2000.com bubble. And in some metrics, we are more expensive now than we were back then, particularly at price to revenue. Rates are in a challenging environment right now, and basically the markets have a lot less room for error, given the fact that we have so much leverage in our system. Data blackouts create risk. We had a data blackout that happened in February 2022 that impacted all of the data feed to the CFTC, the Commodity Futures Trading Commission. And that impacted the ability for us to see what was happening with hedge funds. That was because of a cyber attack. This is a bigger deal because we're halting operations on macro releases like jobs reports, CPI, GDP. And it gives hedge funds and it gives other institutions a much bigger advantage because they have private metrics that they use, re- proprietary analysis tools, proprietary measurements that the average retail person doesn't have. So we have to focus in what we can't see in the wide open. That's why things like ghost prints are so important. That's why it's so important to be focusing on key technical lines. That's why it's very important to look at, deep currents, the Blake. We have regulatory stalls. This can impact filing and approvals. It's going to be a little tricky trying to navigate insider buying, right? It's going to be a little bit more difficult to do that. We will just simply have delays in some of that data, but it can stall market momentum and it can leave us a little blinder than usual, which is why technical analysis is going to be so critical in the next couple of weeks. Now, add on the fact that we're doing this in the backdrop of inflation, supply chain challenges, global headwinds, China trying to get concessions on Taiwan, threats of military invasion in Venezuela, the new carbon laws that are being passed in the EU that's going to impact global manufacturing. This is just one more snowflake on that mountain that can create the avalanche. Just that one last snowflake that can hit. And because of that, you're probably going to see more optionality. I think you'll see implied volatility expand. I think that you will see spreads start to expand and a lot of questions moving forward until we can get some sort of resolution. And on top of this, Trump has threatened to clear house and cut various programs as well. It makes a difference. So you have to keep an eye on a couple of things. The one thing I just note is breadth. Keep an eye on the number of stocks that are falling under their 50-day moving average. The higher this number goes, it will tell you that fewer and fewer stocks are helping to propel the rally and support this market. That's a very critical thing to keep in mind. Secondly, watch the MACD on the S&P 500, on the NASDAQ, on the Russell. That is a key trend line for you. That is a key thing to watch to see what short-term trends are transpiring and what markets are doing in terms of assessing risk. And it's been trading sideways on the daily for a while. We're looking for an actual trend to emerge as a result of this. In addition, keep just a basic eye on what's happening with momentum. We're currently at the 8-day EMA. We break under the 20, a retest of the 50 is possible. But when we get down to that 50 level, that's where we start to see all of that leverage and unwinding happen. And a lot of that has less to do with the government itself and more to do with a race to cash, a race to the dollar, and fear in the markets. And if we have any type of sell off like we had in April, or even a short term spasm like we had last August, keep in mind, even though we are flying a little bit blind on the data side, we will still be able to get access to insider buying and selling data. It will just come in a little bit slower and we'll have to use the 5-day moving average. We might have to bump that up to a 7 or 8 day moving average, which we track. And if that blue line spikes, if this blue line gets up here, keep in mind that it's probably time to buy. Policy changes are coming. And I stress one last thing, and I know this might not be popular, but the reality is this. We operate in an environment now where insiders are getting access to information on policy. And we have seen back in April a huge policy shift that transpired where insiders in Washington and across the country were all buying at the exact same time. Trump came out and said, great day to buy. We had people in the White House talking about how much money they made on the policy shift around Liberation Day. It was evident in the streets. So I highly encourage you to just simply pay attention to what the policymakers are saying, look for hints of recommendations, and watch what the insiders are doing because they are undefeated in every crisis, even short-term downturns going back to 2008. So once again, we don't have to like it. We just have to follow the signal. We just have to pay attention to what these individuals are doing because they might have information that we don't have, and that will provide the conviction necessary in order for us to be more aggressive into the next round of our buying on what will be a Gianni style generational buy. All right. So 1% pattern, we've talked about this in the past. Again, we're looking for a sell-off. We're looking for the insiders to buy. We're looking for a spike. But it is 9 o'clock, which can only mean one thing and one thing only, and that is the runner. All right. Portland has a beautiful rose garden. Well, that's enough for me. I'm in. Don wants me to do impersonation of Eddie Murphy in Coming to America, apparently. Kroger. There we go. We're waking up a little bit on the food side. Again, we've seen this happen before when we get into these periods of uncertainty. Everybody starts buying the food. We're the 20-day moving average looking for this 8-day to cross back up, but I like this for a simple trade. Buying at the 67, trying to trade back to the 68, very tight stop, 10% level, and looking for continuation in trend in Kroger. Improvement, again, we came right back up to this RSI, MFI at break even. Let's see if we can wake up today, 9:30, maybe around 10 o'clock. If we start to see some support and some movement on Kroger, that can take us higher. I don't know much about, I don't think this impacts Snap, but who knows? All right. IPI. We've talked about Intrepid a couple of times. Not really much of an options play, unfortunately, but you're seeing this consolidation of these key trend lines. What we're looking for here is just buying the stock, setting stop back here at that 20-day moving average and looking for a continuation in price to the upside. Strong side on the breakout. And finally, UAMY. This has been quite a darling since the first round of insider buying that took place earlier this year. There was buying back at the 45-cent level on a lot of these by cluster buying. We just saw the chairman and CEO buy 100,000 shares of this stock at 613. Remember, insiders might sell their shares for any number of reasons, but they buy them for one. They think their stock is going higher. You see the strong momentum here. Looking for an opportunity, well, you can try and hope that it pulls back to that 557 level. From here, it's just simply trading to the upside, buying and setting at the 8-day moving average. If it does not hold, we wait. And we're looking again for that pattern that we've talked about in the past, where the 8-day moving average sweeps under the 20 and then carries the momentum higher with it. Add it to your watch list. SoFi, all these alternative financing companies have been under some pressure in recent days. We've seen that move under that 8, under the 20, and now looking to try to retest that $27 level. If it cannot hold, we're looking for an opportunity down to that 24.72 level. CG, Carlyle Group, private equity, asset management, trying to hold on that 50-day. If the markets continue to showcase any weakness, if this cannot hold this level, you're simply buying at the 63 and looking for a move to the downside. I like this as a reversion opportunity this morning. If this stock gets up into the third or fourth deviation of volume weighted average price, then that would put me in a position to potentially short. So if you have your deviation lines out, this is volume weighted average price, blue line, first deviation, second deviation, third deviation. If you have that out and we get up into here at any point this morning, 64, I will be buying the 64 and looking for a reversal back down to where we were yesterday. Finally, on the other side of that, G dot, green dot. It's all the same thing. It's financial credit services. And we missed the week move, 2 days ago, 30th, yesterday. That's an ugly, ugly chart. You got some weakness to the downside here, $14 put, probably out a week. and looking for a retest of that 13, that 50-day EMA. Metals and miners looking stronger. AI tech, of course, why not? Why wouldn't it be? And China tech remaining strong. We've talked about the fact that China is right now the only game in town when it comes to expanding liquidity in the markets. Continued to see this big move on Alibaba. We look at that and Weibo, right? Weibo. I like buying Weibo. I like buying the call on Weibo. I would buy the $12 call out to the 17th of October and look for continued momentum with a 25% stop. Just to pull that up, call spread. Nah, not a call spread. Just do a straight long call. WB 17th. Gonna take our time, aren't we? Taking our time. Yeah. Rock jock my life. Yeah. All right. 75 cents. So you need about a quarter. It's going to be a lower probability trade, about 35%, 34%. Setting a stop back at around 12. What's the line here? What's the 8-day? Around 1220. 1220. That'll be back at the 20-day moving average. I'll put that into the chat when the market opens, but that's going to be something that I'm going to focus on today with our Tesla group as we wrap up Tesla and move to NVIDIA next week. WB. All right. Last ones. We got AIG, MLR, and Triple H. That guy. Remember that guy? Triple H. This is a tough one. Howard Hughes, Piper Sandler has upgraded the stock. We're looking for a dip near 80 for a potential buy here, with a stop at 79 and a target back up at 85. If we hit that 80 level, that's an opportunity to do another spread. 80 to the upside at 83, possibly 84. Buy at the low, sell higher. Call spread. MLR, value play, good company, good name, Miller Industries, cyclicals. It's trying to get off the mat. It has done this multiple times this year where it will sweep back up. If you want to be a little patient, you can wait and see if we get that 8-day move back above that 20-day moving average. But I think it's a good opportunity to try to get out in front of it. The 40 to the 45, stop at 39.10 as the runner tells us. And AIG. AIG, now this is the one that is the problem, right? Because this is the one that breaks down when we have concerns about liquidity in the system. But liquidity is rising right now. It's rising. It's been going up. It's a little stagnant, but it's been going up. It's an opportunity to kind of do a bit of a hero trade on this, and that's where you're buying up at around the $80 level. Very low probability, but just looking for a continuation on covering, and we may get back to that $82, $83 level. But if you're buying it, you're trading it, just keep your tight stop, keep a tight stop right here, right at these key moving averages. I like this as a short-term potential momentum play. $4 or $5 are in play. It's not a heavily shorted stock, but we are back where we were at the lows of April and the doldrums of August with concerns about liquidity. Right now, looking for a bit of that expansion. Thank you, China. And of course, the expectation that we will continue to fund this government. This could be the one that really rallies if the funding comes sooner than later. Targets of that 80 to 81.50 level. So it's a nice little short-term contrarian play for the next few days. All right. Now, we've got some other things going on, don't we? Don's talking about Netflix this morning. Very interesting. All right. Well, as I've said, we got 10 minutes. As I've said, people have some questions about mRNA. We'll talk about it this morning. Why not? Again, another one of these names that teases everybody. pushing these key levels. And it's not a horrible idea, right? Because again, if you see rotation out of tech and move into healthcare and defensives, and then there is a squeeze because this is a heavily shorted stock, this is the chance to take aim. And what you're looking for is not, the move here. You're hoping and you're aiming for something significant, something big, out of the woodwork, a complete push that might define expectations. So if you're going to bet small, these are the types of things to bet small upon because a short squeeze could happen really quickly. And the squeezes, remember, typically they're not starting down here. You want to be above these key moving lines in order to take advantage of said moves. Why is that? There we go. 20, let's see. We got to October 17th. October 17th. October 17th. No, let's go with the spread. Call spread. One moment. I'm going to give you some numbers. We're $25.99. It's October 17th. The $25 call is about 215. The 28 is 95 cents. So with mRNA on a trade like this, your stop, your in the line stop, when this is kind of the important way to think about it, is going to be back at this key, these moving averages, right? So you got 24, 25.40. If you buy the spread, I'm going to tell you in a second, over the next couple of days, if momentum doesn't pick up and it falls back to 24, 25.40, 25.40, your loss would be 10%, 12%, 10%, $12, 10%. So it is a tight stop, but that's the point. Because if this runs and breaks through and gets to 28, then your upside is around 49 to 50% and continues to ride higher over the duration of the next 2 weeks. This is about the mRNA $25 call for October 17th, buying that call and selling the 28. It's about 220 on a dollar. It's going to cost about $1.20. The maximum return is 180. The max return on risk is 150. The break even looks like it's at 26.10. And the probability of profit is 47%. So that's a pretty clean trade. I'm going to put this in the chat for you. All right. Miguel's already on top of it. Let's throw that in the chat. TP trade. Oh, I messed that up. One moment. I know that I can add things. I know I'm not that bad at computers, but you'd be shocked. Desktop. Screenshot. Upload. Nailed it. All right. Cool. We did it. All I can think about now is Don sent this video out. I don't know what time it was, but it's from Coming to America, and it's one of Eddie Murphy's more interesting and flamboyant characters. And I'm still laughing about it. Tom Preston from Tasty, good guy. Talked to him about 3 weeks ago. Long conversation. Last thing. All right. I want to point this out. I think it warrants your focus and your attention. Remember, when it comes to these big downturns, if there is a big downturn, and whether it is in 2 weeks because all of this completely goes to hell, or it happens in 6 months because the liquidity flows dry out. Remember, whatever occurs, the insiders have called the bottom of every major crisis going back to 2008. That's the importance of this chart, right? That's 2009 when QE started. That's where the ECB printed. This is where China printed. This is where we pivoted in 2018. This is COVID. This is the gilt crisis. This is the 10%, 5% move on the 10-year bond. This is April. You can see the little downturn in the S&P. Even if it is the most minor thing in the next couple of weeks, in the next couple of months, remember, our focus remains on the challenges to the reserves in the banking system. And remember, we had a bit of a banking crisis back in 2023. Insider buying spiked. It went up. They all bought because there was a policy change. We're looking for policy changes. We're looking for accommodation. We're looking for an end to tightening in the next Fed meeting. We're looking for possible quantitative easing under a different name. So we have to watch this. And if we are in a downturn, even if it is a minor spike in insider buying, that is going to be the pure contrarian signal. But I want to remind you that every major downturn, going back to 1987, before the algos even really got involved, has carried this type of program, this type of pattern. We start with a breakdown under key moving averages. We sell off. Stage two is exactly what we've talked about when it comes to that reading in the morning, the number of stocks breaking out versus the number of stocks breaking down. We get to the point in two where nobody's buying. No one is buying. There's no accelerated purchasing pattern. There's no stocks up 5% on the week and up on the month and has beta 1 to 2. They're just gone. They're gone. No one is stepping in and buying with fervor because if they did, you would at least have a handful of stocks in sectors that are moving aggressively. And it's not happening. So what happens? The buyers go away, so the sellers stop selling, and then the buyers step in on a squeeze. It's a very short-term move. I predicted it 6 times. It's 2020. Okay. Then when we hit the 20-day moving average and we get above the clouds for just a moment and we're back into positive momentum for just a moment, they dump and they dump in mass, in full force. And now everybody starts panicking. And right around stage 5, this is where Jim Cramer starts crying on CNBC or predicts the Great Depression or, begs the regulators to step in. Like the voice of the market, the person saying, my God, please, somebody help us. We're all going to die. Like that message comes. And the first thing that you should do is not go, hey, I need bullets and green beans. It really needs to be, I need to go back and see what the insiders are doing because every single time we have gotten some level of accommodation, which is stage 6, insiders buy, which is stage 7, we bounce toward that 20-day. We see some profit taking because of algos. We push above the 20-day, push above the 50-day, and then everybody wakes up in a couple of months and says, what the hell just happened? It has been this signal and pattern over and over and over. I can't make it any clearer because once you see it, you will not unsee it ever again. This is how the world works. It's very important that you see this. And it's one of the core things that we're going to be doing in the NVIDIA 4D program. We're going to talk a lot about this. We're going to talk about the stocks that benefit the most from these types of moves. But we're also going to explain how AI has completely distorted that pattern and has enabled and allowed so many gains to be had in such a short period of time, largely because so much of this is very high beta and high beta stocks, particularly around a crowded, noisy trade that has $29 trillion in value to it. Those are the things that recover and rock. NVIDIA is not up more than 100% since April just because of AI. It's up because of market mechanisms. And we're going to talk about that macro. We're going to talk about NVIDIA. We're going to talk about AI, how to use AI for your trading. Again, we are going to start our masterclass next Tuesday at 2 o'clock. And then the 6-week masterclass, 12 editions, runs starting next Thursday. So if you haven't checked out the presentation, please click the link. Don Kaufman's coming up. I'll be back later today at 3 o'clock. I hope everybody has an awesome trading day. Questions, as always, support@theotrade.com. Put Garrett in the subject line. I'm going to drink my coffee. Cheers.